It does take us to our talk of the tape. How much more can stocks rise? Let's ask Tom Lee. He's Fundstrat's head of research and CNBC contributor, live with us once again at Post 9. Nice to see you.
Great to see you, Scott.
You know, since the Fed did their jumbo cut, the market really hasn't done all that much except for one day last Thursday. Why?
Well, you know, I think the Fed unleashed us on an easing cycle, and that's going to be positive. We know it's actually historically positive 3 months, 6 months out. But what stocks do in the next month is a bit of a coin flip, and I think that's what we're seeing because there's some repositioning that took place. And also we're now thinking about the 40 days into the election.
So does the fact that the election is but 40 days away sort of ruin the perfect scenario for stocks to get that post-Fed bump?
I think it delays it, just because, you know, in the conferences that I've been speaking at and seeing wealth managers and family offices, a lot don't want to commit capital until after Election Day. And I don't think it matters who wins. It's just they want to get that event behind them.
Oh, so you think we're going to have sort of a dash to the finish after Election Day is out of the way?
Yeah, and that's pretty typical. You know, in fact, in election years, the November, December rallies are pretty tremendous. And in fact, when markets are up more than 10% in the first half, you also get big rallies November, December, sort of choppy through September.
You think investors are sold on the idea that this economy is going to make it? It's going to make it through. The Fed's going to pull this off. Is any of what we've witnessed since Fed Day doubts about the bigger picture?
So far, so good. This Friday, we get core PCE, and hopefully that confirms inflation is no longer on the front burner. But I'd say one thing I've noticed is that the number of investors and professional money managers that think we're already in a recession is very high. And so I think the evidence just has to be better than expected, and I think those views shift back to soft landing.
When we've seen, you know, recently targets for the S&P, Brian Belsky, I keep bringing him up because he's the most recent to raise his target up to the highest now on the street. I've asked you about, you know, the market lately. You haven't sounded like you'd be raising your own target to a degree like that, would you?
You know, I think there is a lot of upside in the foreseeable future. Let's say 3-6 months out. But for someone to tactically say we need to pin a 6,000 target and then put money to work today, I think it's harder to make that case because valuations aren't on the cheaper end, and we've already had a fairly sizable move. So I'm not saying I'm like bearish right now, but to me, I'd have a lot more confidence saying 3-6 months out, things are attractive, especially things like margin debt, right? It actually decreased in August, meaning investors have been deleveraging. Mm-hmm. It hasn't gone anywhere for the last 4 months at a time when markets are rising.
I guess my point would be it would have been better articulated to just say you don't sound as bullish as you usually are. Is that fair?
You know, yes, I'm bullish into year end, but I'm a little less confident about how markets behave into Election Day. And not that I think we're going to have a huge drawdown. If we do have a big drawdown, you know, I'd be buying that dip. But I also don't think we can make new highs and then see the market blast off after Election Day. So I'd rather sort of say things look a lot better after Election Day.
Can we make new highs if tech doesn't resume its leadership role in anywhere close to the degree that it had?
As long as tech is a market perform. If tech actually declines, that's going to be hard for the rest of the S&P 500 to compensate. But what we've seen so far, including days like NVIDIA and Tesla recently, is that tech is actually holding its own, but other stocks are starting to show catalysts and signs of life.
Yeah. What about the broadening trade? I mean, look, you look at the Russell, your big call, of course. Week to date's down more than 1%. Really hasn't done much at all. I kept hearing, hey, you got to wait till the Fed cuts. Then you go into the Russell. I don't know. What do you think?
Well, Russell had a big week last week. It's some profit taking now. But I think that there's, you know, this is what bottoms look like. I don't think bottoms are straight up. I know in 2021, energy was bottoming, and it was also very choppy, but eventually made not only new highs, but then basically had a blistering gain in 2020, in the year following. So I think that's a multi-year start for the Russell. It feels choppy, but we're still near all-time highs, and there's a big fundamental case to own small caps.
Some have made the case that there are a lot of areas of the market that are overcrowded at this point. So many different sectors have gone up a bunch. You look at industrials and utilities and other things that have traded near or at highs. Therefore, they find better value in bonds. What do you think?
I think a bond investor is buying a bond for a different reason than buying an equity. Because an equity gives you not only inflation protection and benefit from falling yields, but also capital appreciation and positive surprise. Bonds rarely give you positive surprise. I think a bond investor someone should have some income with some capital upside there, but there are so many good opportunities. And, the fact that China has started to actually perform better and potentially broken out, that's, again, a breadth signal, because that's been a big drag for the last few years.
Oh, how about that? Do you feel like the move that happened in China this week's a game changer on how we should view what, the potential turn in their economy means for the overall markets? I mean, we've seen certain stocks get a nice boost, some of the luxury goods companies, right? LVMH, Estee Lauder, et cetera.
And the gaming stocks.
What about in the bigger picture?
It's hard to tell what's a trading rally versus a bottom for China. I spent some time talking to Mark Newton, our technical strategist. He thinks this is a bona fide breakout, and it is coming on the heels of not only stimulus, but in the face of unrelenting bad news for China. So to me, a rally on bad news is a sign that maybe the worst is already priced into China, and that means it could rally for a while.
All right.